Assalamu alaikum and welcome guys to this new video. This video is gonna be the extremely important video, probably the most important video till now which I have uploaded on YouTube. So I will have some discussion before starting the topic. This video is gonna be for learners, not for earners. I have categorized the new traders into types. One who seek knowledge. Two types of traders. One who seek knowledge and they will grind again and again to master the craft. Knowledge seekers and the others, I will say that these are learners. And there's the second group who just want to be the earners. So they will seek, these guys, these will always seek knowledge, and they will practice and grind hard and hard and hard again and again and again, day in, day out, week in, week out. And these guys will seek shortcuts. They will search YouTube, every single video of YouTube, and they will test the strategy 1 time, 2 times, and 3 times, and they will say, no, this is bullshit, it don't work. No, you are bullshit. So these guys will fail, but these guys will succeed. So this video is basically for learners, not for earners. So that's why this video is going to be long than like usual. So these guys cannot even watch the complete video. It's only for the learners group, the type 1. And I'm making this video only for you guys, not for these guys. So let's start this video. In order to understand a market structure, the institutional market structure, you will have to understand, you will have to know what actually the institutions do in this market. So they are saying that this market is run by buying and selling pressure. Then there's ICT who says no, it's algorithmic, prices delivered algorithmically. But who deliver the algorithmic price? It's the institution. So institutions basically do one of only 2 things, just 2 things. Institutions only do one of 2 things. Two things. What's these? They either offer fair value gaps, fair value inefficiencies, or they seek liquidity. So these are the 2 things that institutions do. They either offer fair value or they seek liquidity. It's simple. The complete algorithm is based on these 2 rules, these 2 principles. So algorithm, like whatever the institutions do, it's not buying or selling pressure. It's either seek the fair value, seek liquidity, or rebalance a fair value gap, like this. So let's dig into this video. But with these 2 things, we align our price and time theory in order to trade it. Actually, yes, you will have to know it, but how to trade, this will tell you. Time and price theory will tell you that. Price and time, I didn't wrote this. Time and price, or price and time theory. So let's start the video completely. We will talk about this fair value institution, or that how will you know that whether the institution are offering fair value or they seek liquidity. So let's start. Let's say we have this buying momentum, and then the selling side, sell side delivery, buy side delivery, sell side delivery, and again we have a buy side delivery. So in this buy side delivery here, only buyers had the chance. Only this was just one side delivery, buy side delivery. But if you look at this side over here, it's a sell side delivery. So we have now what? Now from this range low to this range high, we have a fair value area in which both buy side and sell side deliveries are offered equally. So buy side delivery, sell side delivery, this range is termed as fair value area from the range low towards the range high. This is our fair value area. So what is the area where fair value has not been offered yet? Above this, obviously above this fair value areas high. So this is the area where we don't have fair value yet. So institution will deliver fair value. So it will come back to this area, and now the fair value has been rebalanced. Then again move to the upside. So this area didn't had any, like, this was only buy side delivery, then we have sell side delivery. So again from this range low to this range high is again our fair value area, and institution will come back to this fair value area and then move up. This is how market runs. But you will also ask that why price like don't continue from the fair value area and seek liquidity. I have this answer for you later in the video. So this is cycle in buy side to sell side, same story. Let me show you on the charts so you will understand better. I'll start with the Euro USD because it's kind of following the algorithm quite nicely for me. There are as you have watched ICT, if you have watched ICT videos, he says gold is highly manipulated market. Highly manipulated market. What does it mean? It means that in gold, sometimes we expect a like sweep above liquidity. We expect a liquidity sweep, but gold will do the other thing. It will give the candle closing, strong closing, that we cannot say that it's a sweep of liquidity. So starting from euro, I've marked this a little bit, but I will explain it in front of you guys. This area over here is only a buy side delivery. Okay, but let me start it with the left side over here. Yeah, this was only a sell side delivery until this buy side delivery. So it's our fair value area, and the only area where we do not have a fair value is above this fair value gap, a fair value area high. So price will come again to rebalance the fair value, but there are things. How will you actually know that price will respect this fair value area and continue off of it, or it will seek liquidity? That's the tricky question. So in order to identify it, you will have to look above this area, like fair value area, run above the fair value area, and then the retracement back into the fair value area. So if the price is creating fair value gaps while coming into the fair value area, like this fair value gap over here, the sell side imbalance buy side inefficiency CB, then again we have another fair value gap. So why price is creating these fair value gaps? It should not create any fair value gap while coming back into this fair value area, because it was the fair value area. So price should not offer again fair value gaps, fair value areas. That's why these fair value gaps should not be created if we want to continue off of this fair value area. So if we are seeing fair value gaps being created while price is retracing back into the fair value area, then we can expect that it will seek liquidity. So the fair value area's low will be our liquidity. And as you can see, price came down. This sell side movement is one side momentum, sell side delivery. Then the buy side delivery is our fair value area. Once the price closes below this low, then it will be our fair value area. There is one thing about these fair value gaps, like when the price is coming back to the fair value gap, to the fair value area, and it leaves fair value gaps here in this leg over here, the right side leg. So there are three types of fair value gaps. There are three categorization of fair value gap. Number one, it is simple fair value gap, which is called FEG, by BC or CB are the forms of it. Number two, we have breakaway gap. And number three, we have the manipulation gap. So these are the three types of fair value gaps. There is a fourth one as well. It is known as what you should say, mitigated gap. The fair value gap that's been rebalanced once, like this one. So these three are important. You will have to know which are these fair value gaps. Are these fair value gaps? Are these breakaway gaps? Are manipulation gaps? If these are fair value gaps or breakaway gaps, then we will seek liquidity. Or if these are manipulation gaps, then we won't seek liquidity. So you will have to understand the three types of fair value gaps, which I'm not gonna like describe here in this video. This is totally about the institutional market structure. Okay, so these are the fair value gaps, and in this case we want liquidity. Price is seeking liquidity. So sell side delivery, buy side delivery, and then the sell side delivery, it creates a fair value area. From this low to this high is our fair value area. And look at this, price came back to like against rebalance the fair value area and went down. So this is our fair value area next, like from this low, and once the price moves above again, it creates fair value gap. This first and second candle created a fair value gap, so we will seek liquidity as you have seen here. But this all area will again be our fair value area from this low to this high once it breaks below the low. Sometimes we will take the lows or highs, and sometimes we will take the closing areas for fair value areas. Like in this case, I'm taking the low, but in this case, I'm taking closing. So I'm taking the low in this case because it is overlapping with a fair value gap. And if I take like the close, it is not overlapping with the fair value gap. That's why I'm taking the low that is overlapping with the fair value gap. So this is now our fair value area. From this low to this high, this is our fair value areas low to high. And we will look for the direction. Price went down. What is the only area where we do not have fair value? This area below this swing low is our area that where we do not have any fair value. Let me remove this. I will show you. This is the only area where we do not have fair value. So check it out. Price is again coming back to rebalance the fair value without any fair value gaps being created. So created a fair value rebalanced and then move to the downside. Now check it out. This is our next fair value area. From this range low to the high is our fair value area, and in this case we will take the closing because it is overlapping with the fair value gap. If we take the low, it is not overlapping with the fair value gap, so we will take the closing which is overlapping with a fair value gap. So check out this movement into the fair value area. We do not have any fair value gap, and then we will move down from the fair value area because this was the only area below this like closing to this low where we do not had any fair value. So price will seek fair value and it will reverse, like you have seen this over and over again, and it will be on every single chart, every single time frame, because time and price are fractals. You will see it everywhere and on every time, every market, whether it's forex, crypto, gold, index, futures, whatever you are trading. The algorithm is universal for everyone, all of the pairs, all of the market. Now we have again this buy side delivery, then sell side delivery. So this is our next fair value area. From this low to this high is our next fair value area, and check it out. If price is now I'm not taking the lows closing, I'm taking the lows which is coinciding, which is overlapping with this FVG. So price has not came to rebalance this fair value area. That's okay. We can expect it. It's happens sometimes. Once we came down, buy side delivery, sell side delivery. So it's again a new fair value area, which I will again mark the lows, closings of the sell and opening of the buy candle, because it is overlapping with my fair value gap. This is our fair value area. So the only area where we do not have fair value is below these lows. This is the area where we do not have any fair value. So price will now rebalance the fair value. But if you look at this fair value gap over here, fair value gap, and from the first to third candle, we have a fair value gap going into this fair value area. So once, if you look at this, once price has already offered the fair value, it is not offering fair value anymore. So it is doing what? Seeking liquidity. And in this case, you have seen it, it seeks liquidity because it has first offered a fair value gap, then respected that same fair value gap. So it means we are seeking liquidity. And the same will go on and over and over and over again. There's an example which I want to show you guys, like here on this same market, Euro US dollar. If you see this swing go high, swing low, swing high, and I will also mark it. So this the huge expansion. I don't have consider this the strong fair value area. It's a huge expansion, but as you see, this is a manipulation gap, and below this manipulation gap, we don't have any fair value coming into this fair value area, which is what from this low to this high is our fair value area, a bullish fair value area. So once price create a manipulation gap, just below the manipulation gap, we don't have a single fair value gap. So we seek what? We seek fair value, not liquidity over here. We seek fair value. Then again, as we came down into the fair value. So what price is seeking now? Is it seeking fair value in the form of this manipulation gap, or is it seeking liquidity? So once I said it is manipulation gap, so you cannot trade it as a fair value gap. So okay, it is manipulation fair value gap. Then what is price trying to do? It is trying to seek the liquidity, because what it is creating a fair value gap over here. Okay, a huge breakaway gap, and then it seek the liquidity. So sell side delivery, buy side delivery, it is another kind of our fair value area. From the lows to highs of the range, this is our fair value area. The only area where we do not have fair value is above this range high over here, and this is the area where we do not have fair value. So once price coming back into the fair value area, it has again created a couple of fair value gaps. One here over here. You can see a fair value being created, fair value gap. Then we have another fair value gap from this candle's low to this candle's high. So why is price creating another fair value gaps? Because in this case, we have already offered the fair value over here. So we don't need fair value anymore. We want, the price is seeking liquidity, like you see over here. There's a simple thing. Either price is seeking liquidity or it is offering fair value gap. These are the two things which institutions do. And these are the two exact things which upon which the algorithm runs. Like these are the foundation of this algorithm. Let me discuss this case in low time frame. Like we will switch to the 4H time frame and check out what is happening over here. So if you look at this case over here, the buy side delivery, then the sell side delivery, and I will take the candles closing for my fair value area. This is going to be our fair value area, and let me check out if the price is. So The only area where we do not have fair value is below this low. Here we do not have any fair value. So price is again coming into the fair value area and without any fair value gap, without a single fair value gap, and it will move downside. Again, we have our fair value area from this low. I will again take this closing or opening. This is again our fair value area. Buy side delivery, sell side delivery, fair value area. Because fair value area is called where the buyers and sellers are have the equal opportunities of involvement in the market. So buy side delivery to sell side delivery, it is a fair value area. I'm taking this candle's opening because it is overlapping with the fair value gap. If I'm taking the low, it is not overlapping with the fair value gap. So it is overlapping with the fair value gap, and check it out what is price currently doing. Like we have this fair value area, but what is price doing here? It's not creating, it's not offering fair value anymore. It is like seeking liquidity. Where is liquidity? The fair value high, fair value areas high is our liquidity. It is seeking liquidity because into the fair value gap, when price moves into the fair value area, it should not live beyond fair value gaps. Like it is creating one fair value number one, and this is the second fair value gap. And most important thing, price is also respecting the both fair value gaps. Price is respecting the fair value gap, so we seek liquidity. I'm not like discussing the entry patterns over here. I'm just trying to clear your bias. If you watch this video and if you practice on it again and again and again, you will not have any problem at all with your bias, with your daily, with your weekly bias, whatever your time frame is, whatever the time frame you use, you won't have any confusions regarding your bias. So this is the thing that works over and over and over again every single fucking time. Let me now discuss the market structure. So if you have this understanding, then we can explain the market structure. So what is the market structure, institutional market structure? It is based on few things, which is called intermediate term high, intermediate term low, intermediate term high, and intermediate term low, short term high and short term low. Then we have two more things, intermediate term range and short term range. Short term range. These are the few things upon which the institutional market structure is like based on. These are the foundations of institutional market structure. So let me like on drawing, what is an intermediate term high? Basically, it's a high swing high, which is like the highest of the two previous swings, which have lower swings on the left, on its left and right side, like swing high, lower swing high, and lower swing high, and this one is the highest swing high. So this is our ITH, intermediate term high, and the same case will be for the buy side, like for the intermediate term low. We have higher swing low, a higher swing low, and the lower swing low. So it's gonna be our intermediate term swing low. Yes, I know this structure will be like or you will find hundreds of videos on this structure, but you won't find this which I just described. The how will you identify whether the price is seeking, the institutions are seeking liquidity or they are offering fair value? This is the most important thing, and if you combine the intermediate term highs, lows, and market structure with it, you will have an edge over 95% of the traders. So it's not as simple as well. There are these two things, intermediate term range, short term range, and how you will actually identify an intermediate term high and actually you confirm that it will hold the price or it will be a liquidity. So we will dig it down into this topic now. Starting from the same chart, like in this, we will switch into gold. let me okay, starting from this. What do we have here? Swing high, low swing, and low swing. And intermediate term high is confirmed when it has low swing highs on the left and right. But there is another concept as well. The short term high, we have these are our short term highs. ST, short term high, and ITH, intermediate term high. It gets confirmed when it has low swings on both sides of it. But we need two ranges. Like whenever we say it's intermediate term high, we need a range, whether it be it intermediate term range or short term range. This intermediate term high creates a fair value gap over here. Fair value number 1, FVG, and the second fair value gap over here. It creates a range. This is our first range. At this time, we will say it's a short-term range. It creates a range and it's a short-term range. Then when we have this another swing with, I think it don't have fair value gap, so it is now confirmed as intermediate term high. And from this range to this, from this low to the high, we have the intermediate term range. This is our range. Then it is our intermediate term highs and lows are considered as protected highs and lows. In bullish market, our intermediate term lows will be protected and highs will be broken. In bearish market, our intermediate term lows will break and highs will be protected. So in bullish market, any chop, any dump below the intermediate term low will result into buys. And in bearish markets, any chop above the intermediate term highs, I'm you have to consider these intermediate term highs. Any chop above the intermediate term high, I'm saying that it is a liquidity sweep, because we will discuss it how price liquidity sweep the liquidity above or below the intermediate term highs and lows. Then we will be sellers. So now we have intermediate term high, and this is the short term high. Again, we have the short term high, but this low over here is, we have swing low, lower low swing low, and the higher swing low. So this is our intermediate term low, ITL. And now what we are bearish, because price swept the all-time highs liquidity over here in gold. Let me show you on daily chart. You can see here we swept the all-time highs liquidity. So we will be switched into low time frame and our structure will shift. This is the like smart money reversal area. So what do we expect? We will expect the high lows to be broken and highs to be respected, intermediate term highs, I'm saying. Then we have again the swing low, swing high, swing low, swing high. So this is our intermediate term low again. But we don't have any intermediate high except this one. Intermediate term low, it's kind of up strong low, and it can be broken down and it will break down eventually. But going after this intermediate term low, we will need short term lows to confirm the intermediate term low. So this is the short term low, and intermediate term low. And we need what? We need a fair value gap. This is a fair value gap. So this is short term range. It's called short term range because this was our short term swing low. Short-term swing low, so it is short-term range, and this will be considered as intermediate term low, which is confirmed now because price has created a range from this intermediate term low to this intermediate term high. And looking into this FVG, what do we know? We know that price is now seeking the short-term highs liquidity. Price is seeking the short-term highs liquidity because it is not offering fair value anymore. This was the area, the last area where we say that it was a fair value area. but now price coming into this area with fair value gap, so it is not offering any fair value anymore, it is seeking liquidity. You will have to align the fair value and liquidity concept with this intermediate term highs and lows in order to be like perfect on it. Then we have short-term high, short-term low, and I will say above this short-term high, we have short-term high, short-term low, short-term high, short-term low, and now this is our STH short-term high to intermediate term high. This is our intermediate term high because what it has now? It has now two swing lows on the right and left side, two short-term lows, short-term highs, and the two short-term highs, like it has the fair value gap, which is very necessary, and coming into this swing high. This is also a swing high, short-term swing high. This one over here is also a swing high, short-term swing high, and it don't live behind fair value gap, but we have fair value gap over here, and that's it. So coming from the intermediate term high, we created two short-term swing highs, and we have fair value gap with the swing high. So it creates a range, which confirms our intermediate term high, and this is gonna be our strong and protective high. This is how ICT says these lows or these highs are protected. He doesn't use the SMC structure, he used this. Where was our intermediate term low? At this point, we have this swing low and this swing low. So this swing low over here is our intermediate term low. Let me classify you why. We have the swing low, and the lowest swing. And coming from that intermediate swing low, we are creating fair value gaps over here, number one. It itself creates our intermediate term low, and we have again the fair value gap over here. So it is our intermediate term low, and we are saying we are bearish on gold due to our high time frame premise. So we will say that the intermediate term lows will be broken down and the highs will be protected. So price seek liquidity, and we knew why it will seek liquidity, because price is creating fair value gaps into the fair value area while coming into the fair value area. Again, fair value gap, and this was our fair value area because it was a buy side delivery, sell side delivery, then the buy side delivery. So it is our fair value area, and price is coming into this fair value gap area while creating fair value gap. So it is not seeking fair value area anymore. It is seeking liquidity in the form of the intermediate term low. So this intermediate term low and intermediate term high, the range from this low, the ITLs to the ITH, is termed as the dealing range. This is what ICT refers to the dealing range. This is our dealing range, and in this dealing range, we now expect that price is seeking the liquidity. So it is intermediate term lows liquidity. Once price seek the liquidity, we will again have like market structure where are our intermediate term highs and lows. In this swing, we have only this one is again became our intermediate term high because it has lower swings to the right and the left side, but we will consider the highest to be the protected one. And we have swing low, swing low, swing high, swing low, swing high. This is single candle like, so I will kind of swing low, swing low. We don't have any intermediate term low, but we have this one as intermediate term. I'm selling it intermediate term high. This is our intermediate term high now, kind of protect the swing. That's why price has not swept the liquidity. And again, if you know the definition of fair value gap, manipulation gap, and breakaway gap, you will see this was a manipulation gap because it swept the liquidity over here and closed above aggressively. So from that intermediate term high to this intermediate term low, now you see swing low, and the lowest swing low, intermediate term low. It is our what you will say, intermediate term low. But personally, I would like the market to sweep this liquidity, and I was expecting the market to sweep the liquidity. I was kind of very sure it will like sweep this intermediate term high at least, because if we are considering this one is the manipulation gap, because it first trapped the sellers and buyers, that price is just sweeping liquidity and then close above it. But this was an original fair value gap for me. That's why I was seeking this intermediate term highs liquidity, which it didn't. So it happens in gold. I said that ICT says it's highly manipulated market. It just left the high with around couple of pips, like 17 pips, I would say. Yeah, 1.7 pips or 17 pips. So it left the high, which should be like its liquidity should be taken out. But it's gold, you can expect some kind of manipulation in it. Intermediate term low to intermediate term high dealing range. Then once our intermediate term low is confirmed by fair value gap, we have the intermediate term short term low. So it is our intermediate term high low, and we have this fair value gap. Now what we will seek, whether the price is seeking fair value in the form of sell side, buy side delivery. This is our fair value gap, fair value area, I would say. And let's see if price is seeking fair value or it is seeking liquidity. What is it doing here? It is creating fair value gaps. So it is not seeking fair value anymore. It is seeking liquidity. Where is the liquidity? The intermediate term low is our liquidity. It seeks the liquidity, and then we have confirmed our intermediate term high, because it has swing lows, lower swings on both sides, and we have fair value gaps, which confirm the intermediate term high. Now we have the low, like swing low, this one, and swing low. So this one is gonna be our intermediate term low. And I just don't categorize the intermediate term highs and lows by the short term lows and highs and lows alone. I want liquidity. I want fair value gaps. So if I see a fair value gap over here, I will say yes, my intermediate term low is confirmed now, because this creates a range from this till, like, if we are in the live price, we will say yes, it is our range. And if price has created a fair value, then what we are seeking, we are seeking either fair value or we are seeking liquidity. So in this case, when price again came back, like for till here, we have this area, this dealing range. From this, I will take the opening and closing. This is our dealing range. This is our fair value area. So if the price is coming without fair value, it has, like, at this point, price rebalanced the fair value with this week, but it has created a fair value gap. So it is not seeking fair value anymore. It is seeking liquidity in the form of this intermediate term high. And look at that high. It has been swept because of this fair value area, and we have this fair value gap coming into the fair value area. So it's kind of the earliest indication you can get from the intermediate term highs and lows to be broken down are these are the kind of protected ones. Once price has swept the intermediate term high, then we have this intermediate term low to this again, the next intermediate term high is just formed again quickly, because we have the short term high in the form of this swing high. Then we have, if you can see, swing low, swing high on the right side as well. So kind of intermediate term high, but I will not categorize a strong, it is to be a strong intermediate term high yet, just yet. I want a short term range or intermediate term range below it. So this swing low, this low short term low swing high is creating a range, is creating a short term range. This FVG will be said that it is creating a short term range. It is confirmed that it is our intermediate term high now. Coming off of that short term range, we have again short term swing high in the form of this swing high, and we are now again creating fair value gaps. So it means that we are seeking the liquidity of intermediate term low because this was our dealing range till this point. The only area where we do not have the fair value was this week. So once price came back into it and it is creating fair value gap, so it means that institutions are seeking the intermediate term lows liquidity. Okay, though, so short-term swing high, FEG above it, we are against swing low, and this is kind of short intermediate term swing low as well, because on the left side it has left and right side it has higher swing lows, swing low, and lower swing low. And price is doing what? It is again creating fair value gap while coming into this, while going back into the range. This was our range over here, and it is creating fair value. So I will say this is our range because these are the last buy, sell, delivery, buy side delivery, sell side delivery, and this is our fair value area. So price is creating fair value gaps while going to the coming back into the fair value. So it is not seeking fair value anymore. It is not offering fair value anymore. It is seeking liquidity in the form of this short-term swing high. And we have fair value gap above it. So once it swapped the liquidity, our instant target is going to be the intermediate term low, because now we are like liquidity, but we want the intermediate term high to be confirmed once before targeting the liquidity. So swing high, short-term swing high, it is our intermediate swing high, but it is not the protected swing high just yet. We need a short-term range coming off of that intermediate term high. What does it mean? It's short-term swing high, another short-term swing high, and from that swing high we have a range. We have a fair value gap. So it is creating a short-term swing, a short-term range, and it confirms our intermediate term high to be the protected one, to be a strong high, to be a structural point. So once price created fair value gap, traded back into a fair value gap and swept the liquidity. Then again, we consider that from this low over here where we do not have fair value. So price has not yet closed below it. So I will consider it to be the complete area from this to this area as our fair value area. And once price again comes back into a fair value, moves down, then we have this fair value area. So in this fair value area, we will categorize our short-term and intermediate-term highs and lows. If you look at this high, swing low to the left side, but don't to the right. So this is still a short-term high for us, not a strong protected swing high. It's still our short-term swing high. And while coming into this fair value area, this was our fair. In this case, I'm taking the wicks because it is overlapping with the fair value gap in either case, whether I take the wicks or the opening and closing of the previous candles. So this is our range, the fair value area, and coming into the fair value area, we are creating what? We are creating an intermediate term low. If you focus on this swing low, and again another swing low. So it is now what? Our intermediate term low. But it is not yet protected. We need a short-term swing range, like this is short-term swing low, and we have the fair value gap. So we are now offering, we are no more seeking fair value. We are no more offering fair value. We are now seeking liquidity because price is creating enough fair value gap. These are all bullish fair value gaps. BC. In this case, we are now we are no longer offering fair value. We are seeking liquidity in the form of this short-term high. And this is going to be our intermediate term low, a strong low. because it has swing low, and the lowest swing low, intermediate term swing low. But this is created by the short-term range from this short-term swing high to this swing high in the form of this fair value gap. It creates a short-term range, and from this short-term range, like from this intermediate term range to this intermediate term low, this is our dealing range. This is our intermediate term range, or you can say intermediate term dealing range. So at looking at this, I'm not like I'm now expecting this intermediate term high to be like its liquidity to be taken out, because we are creating enough fair value gaps, and we have also taken the short term swing high. It was just a short term swing high. If it was an intermediate term swing high, then I would have seen a reversal, and I would have expected a reversal. If you have watched my last video on YouTube about the analysis for Canadian dollar CPI about gold, I said that I don't want this high to be swept. If price sweeps this high, then the conditions will be lower probability for me for sell side. So price has swept the high, so it's like lower probability conditions for me, because price is creating enough fair value gaps. It is respecting the fair value gaps, and it will target the intermediate term high. So let's check it out. And this is what the institutional market structure works. This is how ICT uses market structure on his personal charts. And this is how you will know that price is seeking liquidity or it is offering fair value gap, fair value. This is the most important video in my opinion. Like, I have over 100 of videos on YouTube, and this one is like kind of a gem for those who want to learn, not for those who want to learn with shortcuts. And you will find hundreds and thousands of videos on these structures, but you will not find this the thing that price is seeking liquidity or it is offering fair value. That's all for today's video. Practice it, and practice it until and unless you master the craft, you master the art. Thank you very much for watching the video, and give it a thumb if and if I get enough reaction on this video, like if there are 100 views and I want minimum 50 likes on this video, then I will also come up with the entry pattern, like how will you enter in these areas. If the price is seeking liquidity, how will you can take positions for your loan here? Or if the price is just offering fair value, then how will you enter, how will you position yourself, how will you enter in the market? This will be the next video, but after this goal is achieved. So that was all about today's video. Thank you very much for watching the video. Make sure you are subscribed to the channel in order to get latest updates and videos like this. Goodbye, folks.